Thinking about hiring your first employee? Don't make this mistake. If you're paying someone $25 an hour, your business's actual employment cost is not simply $25 an hour. There can be employer CPP and EI costs, vacation pay, workers' compensation costs where applicable, benefits, payroll administration, training, equipment, and potentially much more. Before you hire based on the wage, calculate what that employee will really cost your business. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. Hiring employees can be one of the most exciting signs that your business is growing, but it can also become one of your largest financial commitments. Today, I'm going to show you why business owners should calculate the fully loaded cost of an employee before making that hiring decision. Start with the wage. Let's use a simple example. Suppose you're considering hiring someone for $25 per hour. At 40 hours per week for 52 weeks, that's approximately $52,000 in annual gross wages. A business owner might look at that number and think, okay, I need $52,000 to hire this person. Not so fast. That's the employee's gross wages. It isn't necessarily your total cost as the employer. Then come the employer costs. Depending on the employee and circumstances, your business may also have costs such as employer CPP contributions, employer EI premiums, vacation pay or paid vacation entitlements, workers' compensation premiums where applicable, and depending on your company, health benefits, retirement contributions, bonuses, paid sick days, training, software licenses, computer equipment, cell phones, uniforms, office space, recruitment costs, and payroll administration. Suddenly, a $52,000 salary represents a much larger financial commitment. Imagine a small business owner says, "Everald, we're extremely busy. I need another employee." My first question shouldn't necessarily be, how much are you going to pay them? I want to know, can the business financially support them? Suppose the new employee costs the business significantly more than their base salary after all employment-related costs are considered. Then we need to ask, how much additional revenue will this person help generate? Will they allow existing employees to become more productive? Will they free the owner to generate more business? Will they improve customer service or capacity? And most importantly, will the financial benefit justify the additional cost? That's how you turn hiring from an emotional decision into a business decision. Understand the break-even point. Here's a concept I want every business owner to learn. Your new employee needs to create enough economic value to justify their total cost. That doesn't mean every employee needs to personally generate sales. An administrative employee, for example, may free the owner to spend more time selling. A bookkeeper may improve financial controls and reduce costly errors. A customer service employee may improve retention. An operations employee may increase capacity. So value isn't always measured through direct revenue, but you should still understand what financial problem is this hire solving: the cash flow trap. There's another issue. Payroll happens on schedule. Your customers may not pay you on schedule. Imagine hiring 3 employees because you've just won a major contract. They're paid every 2 weeks, but your customer doesn't pay you for 60 days. You could have a profitable contract and still experience a serious cash flow problem, financing the payroll required to deliver it. That's why hiring decisions need to consider both profitability and cash flow. Never hire based only on what you're going to pay the employee. Hire based on what the employee will cost the business and the value the position should create. That's the difference between simply increasing payroll and investing in growth. Before you hire, run these numbers. Before adding your next employee, estimate base compensation, employer payroll costs, vacation and other required employment costs, benefits if offered, training and onboarding, equipment and software, additional overhead. Then ask, how will this position improve revenue, productivity, capacity, risk management, or profitability? Now, you're making the decision like a CEO. At Melbourne Accounting Solutions, we help business owners understand the financial impact of major decisions before they make them. If your company is growing and you're thinking about hiring, let's calculate what that employee could really cost. Let's look at your cash flow. Let's look at your break-even point. And let's determine whether the business can comfortably support the position, because hiring the right person at the right time can transform your business. Hiring before the numbers support it can put tremendous pressure on it. Before posting your next job advertisement, ask yourself, do I know the total annual cost of this position and what financial value I expect it to create? If you've only calculated the hourly wage or salary, you haven't finished the calculation. I'm Everald Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, and build stronger businesses. If you found this lesson valuable, please subscribe to our channel so you never miss future Canadian business, tax, accounting, and financial insights designed to help you succeed. And if you're preparing to hire or expand your team, contact Melbourne Accounting Solutions. Let's run the numbers before you add the payroll and make sure your growth is financially sustainable. Helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.